Hidden taxes. It's just been one of these things now that's starting to creep up as a lot of our incomes are increasing. Now, there's this concept called bracket creep. And when we go through periods of time of inflation, wages increase, costs increase, and governments love it because people start to earn more money, pay more taxes, and they start to move into the various different tax brackets. With those tax brackets comes the concept of bracket creep and all these other little hidden taxes that are a part of it. I'm going to name a few of the hidden taxes that you, as you start to earn more income, need to be made aware of. Now, you might not be chatting with your accountant on a regular basis because the cost or potentially the complexity or non-complexity of you as a person, but these are some things you need to consider as you start to earn more money. So a couple things that we're going to be talking about today are things like the Medicare levy surcharge, things like excess superannuation contribution tax, Division 293, which I'm seeing a lot more people. I'm actually going to go outside federal taxes and just talk about one little thing that's come through just recently but had very little media attention. And that's now no further indexing of the New South Wales land tax threshold. And that's going to catch a lot of people off guard. So stay tuned all the way till the end when we talk about land tax in New South Wales and the no further indexing of the threshold. I'm Jeremy Nutzelli. This is what school should have taught you. And let's get into today's episode.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Nutzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
Now, the first tax I want to talk to you about is the Medicare levy surcharge. The threshold really hasn't increased over the last number of years. Now, the government wants us to take out private health insurance, but not just any old private health insurance with hospital cover. And that means if we're a single or a couple, we have some income thresholds we need to meet. So roughly individuals, they can earn about $90,000 before they start to pay either 1.5%, or even up to 2% Medicare levy surcharge, which is an additional tax that you will pay at the time of completing your return on the basis that you did not hold private patient hospital cover. And for singles with dependents, that roughly goes up to about $180,000, but your dependent must be covered on your policy. And for spouses, again, that's the same threshold as a single with dependents. The threshold roughly increases by about $1,500 per dependent. So speak to your accountant to make sure that you understand if you do need private patient hospital cover. As our incomes have started to increase, a lot more people are now having to pay private health insurance patient hospital cover. Now, is it a bit of a scam? Well, yes, because if you don't have private patient hospital cover, private health insurance, you're going to be having to pay Medicare levy surcharge. Now, for us, my family, including my 2 children, we roughly pay about $4,000 per year. Do we really use our private health insurance? Not really. Other than a couple little things throughout the year, I would dare say that we're actually down. However, if I didn't have private patient hospital cover or private health insurance in general, with hospital cover included for myself, my wife and our 2 children, would be roughly paying around about $4,500 in Medicare levy surcharge. So I'd rather be paying $4,000 a year in private health insurance to get at least something than $4,500 a year to get nothing. So it is important that if you are approaching those thresholds, you need to weigh up, is it worthwhile from a numbers perspective to pay the Medicare levy surcharge or to get private health insurance? Sometimes you might find that a basic hospital cover private health insurance policy may be more in spending on an annual basis than it would be to pay the Medicare levy surcharge, and vice versa, where the Medicare levy surcharge would be a lot more expensive than paying private health insurance hospital cover. It is important to note that if you are a family, your children must be included in the private health insurance policy, because if they are not, you will be paying the Medicare levy surcharge even if you and your spouse do hold the health insurance, because the ATO say that both you, your spouse, and all your dependents must have private health insurance and be covered up for patient hospital cover. Now, I do believe it does go up to the age of 21, so a dependent is included and should be included on your hospital cover if they of the age of 21 or below. So if you've got some adult kids above the age of 18 but below the age of 21, be sure to include them on your private health insurance cover. Now, the next thing, as our incomes are starting to grow, and this is more aimed at higher income earners, we have this concept called excess superannuation contribution tax. Now, when you contribute or your employer contributes more than the annual cap, which at present is about $30,000 a year, the ATO will actually charge you your marginal tax rate as what they call an excess contribution tax, less the 15% that the superannuation's already paid. So if you're the highest level of income earner, you'll be charged 47%, less the 15% as a tax offset. You do have the choice to pay that out of your own back pocket, or you can get about 85% of that excess contribution being released from your superannuation to pay the tax and obviously put a bit of money in your back pocket. But make it known that your super fund will be reducing as a balance if you decide to do that. Now again, as a lot more people are earning more or might be salary sacrificing more into super to build their wealth, you've got to be conscious that you don't exceed the limits or the thresholds, because if you do, you will be paying the excess superannuation contribution tax. If you have no choice and your employer is contributing more than the $30,000 per year, brilliant, take it as a bit of a bonus. You still have the opportunity of releasing the excess contributions from super to be able to pay that obligation. Now, a little known fact, even though the superannuation guarantee from 1st of July 2025 is going from 11.5% to now 12%, which is fantastic for all employees, you need to note that an employer by law only needs to contribute $30,000 of superannuation or up to the cap based upon your income. So that means that if you're earning $500,000 a year and arguably your contributions would be $60,000 a year, well, your employer actually only has to contribute $30,000. It is at their discretion to contribute the additional $30,000 if they wish to, based upon your employment contract. So that's a little known fact. Now, another big one that's capturing a lot of people, whether you're a high income earner or a low income earner, is this Division 293 tax. Now, it's been around for some time and the threshold used to be $300,000. But around the time that Julia Gillard was in government, out of government, the threshold actually, believe it or not, went down from $300,000 to $250,000. And for the last about 10 years, the Division 293 tax threshold of $250,000 has not changed. So while our incomes have been increasing, inflation's been going through the roof, and the economy's changed drastically, the Division 293 threshold has remained the same. It is purely a money grab by the government. Now that means when I talk about a threshold being $250,000, how is it calculated? When your salaries and wage income plus your superannuation contributions, either from salary sacrificing or by your employer, exceeds $250,000, you will be paying 15% additional tax on the contributions, either the amount above $250,000 capped up to the maximum amount of contributions that have gone into the fund. So for many years, this $250,000 threshold, which mind you came down from $300,000 back in 2014, has not been indexed, nor has it increased. So it's capturing a lot more people year on year as their incomes are starting to increase or as they sell assets. I've had a number of clients who have sold properties in the 2024 and 2025 financial year, earning modest incomes of $100,000 to $120,000 a year, made some really good capital gains, but all of a sudden, their superannuation contributions that their employer have been putting in is now taxed not at 15%, but at 30%, meaning there's an additional 15% tax that the ATO will levy. Now, you as an individual, you have the ability to pay that out of your back pocket, or you've got the ability to have that additional 15% Division 293 tax being released from your super. So these are a couple of the little hidden taxes that's out there. Division 293, don't get it mistaken with the Division 296 that's been newly introduced and just recently passed the lower house or the House of Representatives. This Division 293 has been around for a long time. It's not based on unrealised earnings. It's purely based on the superannuation contributions that go into the fund and how much you exceed that Division 293 cap of $250,000. Now, the last little bit of hidden tax I want to talk about is not federal-based, but New South Wales state-based. It has received no media attention. I had to dig through this when it first came out. But at present, the New South Wales land tax threshold sitting at roughly about $1,075,000, meaning you can hold as an individual or as a company with an individual shareholder a value of land here in New South Wales per person of up to $1,075,000. Now, for many, many, many years, the land tax threshold has been indexed. When I first started as an accountant and a property investor, the threshold was around about the $300,000 mark. And over the space of the last 15, 16, if not 17 years, it's gone up to about $1,075,000. Now, a notice was done around about 12 months ago. And again, it wasn't publicly out there. It wasn't all over the media being splashed. But New South Wales have now capped the threshold of $1,075,000 and are no longer indexing it. New South Wales has been one of the states where it's received on average, the largest amount of growth year on year. And from a denominator perspective, it probably holds on average the highest land value per property across all the states. Now, the New South Wales state government have said and hidden behind the fact that we are just being more consistent with a lot of the other states around the country, which is true. Queensland haven't increased their land tax threshold for a long time. Victoria's actually brought theirs down. We all know the mess that they're going through from a state government perspective. Northern Territory, there's no land tax, so we don't need to worry about. South Australia really hasn't moved the dial for many years. Neither has Western Australia, the most common states that people have been investing in. But for New South Wales, which has seen a significant increase in land values, I know that the amount of land tax that I pay drastically has been increasing year on year because the land values just simply seem to exceed what even I thought the level would be. This means that land tax for many people who are investing in New South Wales has just become more expensive. So that's something I just wanted to bring to light because not many people know about it. It went through the media with absolutely zero noise. I didn't see it posted anywhere. I didn't even see the Australian Financial Review pick it up as a story and run with it and splash it all over our social media pages. So again, if you're a New South Wales investor, the land tax might just be getting that little bit more expensive for you because they are no longer indexing the threshold. So I just wanted to share those 4 little hidden taxes. There's many more out there, but these are probably the most common. You've got the Medicare levy surcharge. You've got the excess superannuation contribution, which again means that you're contributing more than the annual threshold. Division 293, which is catching a lot of people out now, especially if you're selling assets and your income, including the superannuation contributions being made, are over 250. And that nasty one, which is here in New South Wales, land tax threshold is no longer being indexed. If you're liking this content, don't forget to like and subscribe on iTunes and Spotify. Or if you're watching us on YouTube, smash that like button, hit subscribe for more juicy content. I'm Jeremy Anzelli, and this is what school should have taught you.